Coming up on Market to Market. Torrential rain swamped Northern California, but fall short of ending an epic drought. And entrepreneurs learn to grow food year-round in the heart of the Windy City. Those stories and market analysis with Sue Martin next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, December 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. U.S. consumers loosened their purse strings last month, revving up sales of autos, clothing, and electronics. The Labor Department said the Producer Price Index, a measure of the cost of goods and services before they reach the consumer, fell 0.2% in November. However, when the volatile food and energy sectors are eliminated, the index remained even with last month. American consumers are already seeing lower prices at the gas pump, which has left them with more money to spend on other items. According to the Commerce Department, retail sales rose a seasonally adjusted 0.7% in November. But when purchases at the pump are stripped out, the figure climbed an even more impressive 0.9%. This was coupled with accelerated spending on vehicles, clothes, online purchases, and electronics. The sales figures indicate that consumers are increasing their holiday purchases despite a dismal Black Friday. But shoppers from Washington State to Mexico may have had a bit of a problem getting to the mall late this week as the Pineapple Express ran full speed into the West Coast. One of Mother Nature's cruelest ironies is a flood in the middle of a drought. But that's what folks in some parts of California dealt with this week as an early December storm provided a bit of relief to California's drought. Many residents spent this week preparing for the storm by sandbagging areas prone to flooding. By early Thursday morning, some San Francisco neighborhoods were inundated with water from what is expected to be one of the windiest and rainiest Bay Area storms in 5 years. On Thursday, at least 200,000 people were without power, and high seas were making ferry travel difficult in the region. In Northern California, roadways were flooded and trees toppled. This home was swept off its foundation and into the sea as hurricane-like winds slammed the coastal regions. Heavy snow blanketed the ski areas in the northern Sierra Nevada, forcing schools to close with the whiteout conditions. This is the second consecutive week of a major storm hitting the West Coast. Last week, rain pelted several regions, providing much-needed relief to one of the driest periods in California history. But much more precipitation is still needed. Digging into the Drought Monitor archives, you can see the 3-year progression of the arid conditions. 2013 was the driest calendar year for the state of California in 119 years of recorded history. And last week's rain did help a large portion of the northern, central, and southern coastal sections of the state. However, it will take a lot more moisture to recharge California reservoirs, as many are 2/3 below capacity. No revisions were made to the California drought depiction map this week. The entire state is still in some form of drought and has been since March. Plus, more than half of the state is in the most severe stage. But that could change if this week's rains are as significant as predicted. Many entrepreneurs rely on business incubators to accelerate the growth and success of their companies. The National Big Business Incubation Association boasts of more than 1,400 members in the United States and a total of 1,900 members in 60 nations around the world. The incubators vary in their strategies. While some operate on a virtual basis, others feature an actual physical space meant to foster networking and sharing of common goals. And as David Miller discovered earlier this year, a case in point can be found on the south side of Chicago, where entrepreneurs have refurbished an abandoned meatpacking plant into an incubator that produces greens and gills.
Snow on the ground in the Midwest is usually a clear signal that fresh, locally grown produce is no longer available. But for some residents of Chicago, the supply never dries up, even during the most inclement weather. On the south side of the Windy City, David Ellis and his business partner Eric Roth have joined several entrepreneurs who are pushing back against Old Man Winter.
This all started with a vision for capitalizing on a need in the marketplace, and that need was locally sourced produce. What we saw was just that there was a demand for it, and that demand was only growing at an all-time high and only growing. And in the Midwest, the source for it was very minimal, almost non-existent, other than the summer months. So for a year-round production company, there was a gap in the marketplace that we felt we could capitalize on.
To take advantage of that gap, the pair, along with a silent partner, invested more than $150,000 of their own money to market microgreens, leafy vegetables, and fish under the name Greens and Gills. Their secret weapon against bad weather stopping food production is aquaponics, a closed-loop system that uses water cycled between fish tanks and plant beds. And to maximize the use of their 4,500 square feet of space, a portion of the product is grown on shelves, adding a vertical component to the operation. By being located in Chicago, orders for fresh greens can be filled in as little as a few hours, while the fish are ready for sale every 6 weeks. Selling the greens has actually been easier than the fish because chefs in the metropolitan area have difficulty balancing the purchase price against the cost of processing. Greens and Gills is the first licensed aquaponics farm in the city of Chicago and just celebrated its first anniversary in January. But long before the first pipes were connected, Ellis poured 2 years into research and development. The pair credits some of their success to a distinct division of labor. Roth handles nearly all of the production, while Ellis oversees the marketing. The produce from Greens and Gills vertical fields are marketed through a food distributor as well as directly to upscale restaurants located in Chicago's downtown business loop.
Chefs sometimes can be hard to get in touch with, but it's on me to just cold call them. You know, I walk in the door, I come in with a cooler with microgreens and fresh cut basils and French sorrel and lettuces, and generally their first inkling is another vendor calling on me to try to get another product in here. But when my opening line is, I'm David Ellis, I co-own and operate an indoor urban farm right here in Chicago, they're usually pretty receptive to at least see what I have and do a tasting and talk from there.
The chefs at Sienna Tavern were one of Greens and Gills' first customers.
Texture, flavor, appearance, everything, start to finish, is phenomenal. They love to experiment and do new things, so every now and then Dave will come around, and it's that one-on-one interaction with the farmer that goes that much further.
Greens and Gills is located in an unlikely place, the basement of a remodeled meatpacking plant. There are 7 entrepreneurs like Ellis taking advantage of this green business incubator located on the south side of Chicago called The Plant.
Here in Chicago, the average vegetable has come maybe 1,500, maybe 2,000 miles to get here. That's silly. We have a talented workforce just on the other side of these walls. We have all of the resources that we need right here in Chicago, and this is where the food is consumed. So why are we transporting it? So the plant exists to figure out new ways to not only grow food in a city, but also how to process it in an efficient way.
The Plant is John Adel's second business incubator. A former television art director, Adel has devoted more than a decade to helping innovative entrepreneurs get their start. The nearly 95,000 square foot structure was purchased by Adel in 2010 for $525,000. With the help of friends and volunteers, he was able to get things started. Adel's grand plan is to have the tenants create products, process the waste from those products, or provide power for the building in a closed energy loop. The concept of growing locally sourced food appealed to Urban Canopy owner Alex Poltorak. The young entrepreneur began volunteering at the plant nearly 4 years ago and decided the innovative incubator would be a good place to start a business. After investing $100 in some wheatgrass seeds, Poltorak began selling product out of his home to area juice bars. In 2011, he brought his new business to the basement of the plant and eventually moved upstairs to a 700 square foot vertical farming space.
We call it a for-purpose business. So in the eyes of the IRS, it's still very much a for-profit business that they tax. But at the same time, the way we measure ourselves and what we try to do as a business is very much socially oriented. There's a purpose of how do we feed people, how do we create those economic benefits to the community, and how do we improve community wealth and health and stuff like that. So that's the purpose of the business.
Poltorak handles all of the production, and 4 full-time employees take care of distribution. He continues to sell wheatgrass to juice bars, while the rest of the products are sold to members of his community-supported agriculture project and a few restaurants. Poltorak says Urban Canopy is making money, but the profits are plowed back into the operation.
When I take a step back, I really love it. On a day-to-day, it's still very hard, and it is in this phase of growth that's also difficult to manage. And for me, it's definitely very stressful and challenging to figure out. When I look back on what collectively our crew has accomplished over the last few years, it's astonishing. And there's still a long, long way to go, so it's exciting to see.
Poltorak and Ellis plan to stay at the plant indefinitely to supply fresh, locally produced food to Chicago consumers year-round. But there is still plenty of space for a few more small businesses to pull themselves up by their bootstraps and help Adel get one step closer to his dream. For Market to Market, I'm David Miller.
Next, the Market to Market report.
Government reports with a slightly bullish slant and rumors of a possible reduction in 2014 harvest numbers pushed grain prices slightly higher. For the week, March wheat gained nearly 13 cents, while the nearby corn contract moved more than 12 cents higher. Soybeans continued their upward climb as the January contract rose almost a dime. Nearby meal prices followed suit, adding more than 60 cents per ton. In the softs, the pressure came off cotton this week as the March contract added 90 cents per hundredweight. In the dairy market, December Class 3 milk lost a nickel, while the deferred contract declined by 34 cents. Livestock prices were lower as the February cattle contract lost $2.70. Nearby feeders dropped $9.27, and the February lean hog contract gave up $2.10. In the financials, the euro gained 2 basis points against the dollar. Crude oil continued to fall as the January contract lost nearly $8 per barrel, the lowest price in more than 5 years. COMEX gold rose $32.30 per ounce, and the Goldman Sachs Commodity Index continued its 3-month decline, dropping by nearly 30 points this week to settle at 446.90. Here now to lend us her insight on these and other trends is one of our regular market analysts, Sue Martin. Sue, welcome back.
Thank you, Mike.
Let's jump right into this wheat market. Who would have guessed that with the tremendous global supply of wheat, we'd be looking at over $6 March wheat this week?
Well, we are, and of course, the USDA supply-demand report was actually vented a little negative. U.S. wheat supplies went up 5 million bushels, and the global supply went up over 2, maybe almost 4 million metric tons. But at the end of the day, it all goes back to Russia, and there was talk today that, of course, on the part of traders, I would say, anticipating that if the oil continues to break like it is, and if the ruble, the Russian currency, continues to fall, which I think it's at like 5-year lows, then there's thoughts that Vladimir Putin may back out of the Ukraine and kind of step back away to kind of ease sanctions. I don't see him doing that. He doesn't strike me as he would give up that quite that easily. But yes, the country's feeling some pain. They're in recession. And then you also have basically dryness still going on in the middle and lower Volga River basin. The Ukraine is dry as well. They should get some moisture here, but they need good snow cover. And so far, they're just not really getting enough. There's also been talk of Ukraine backing out of corn shipments into China. And so all of this was feeding on each other, and the markets went higher after they'd had a little correction. And we actually closed at higher levels and over the previous highs since the October 1st lows.
Now, that being said, would this be an opportunity, do you think, to make some sales? Or since we've closed above the highs, does it look like we're going to trend higher in this wheat market?
Well, I think we can go a little higher. I think we could see wheat, March wheat, get up towards the, in Chicago, maybe around 650, 670, something like that. The KC maybe closer towards $7. But that would be about the extreme I would expect. And I would suggest that traders, or not traders, but producers, make some cash sales. This is an opportunity, and usually January can be kind of a negative month.
You bet. Sell when you can, not when you have to, that kind
That's
of
right.
environment. Speaking of that, let's jump down into the corn market, up above $4 here in the March corn contract.
Right.
You mentioned the Ukraine may be defaulting on some of its corn sales. Is that one of the main drivers here, or what's moving this corn market?
Well, it was the main driver, I think, for today, but export sales have been good. And seasonally, exports tend to get better on corn as you go through the winter. I think that also there's been talk that China's about, because of the U.S. Grain Council, working with China to resolve the issue with the ban on DDGs. It sounds like they've maybe got that close to being very much resolved. There was 3 cargoes of DDGs over to Turkey that were rejected this week because they're enforcing their GMO standards or rules. And there was a cargo en route to Turkey that ended up getting rerouted somewhere else. But then when China's news came out, all of a sudden nobody cared about Turkey. It was all going to China. So that's been a big plus. And of course, values of DDGs picked back up and aligned better with corn. So there was support under the market. Farmers selling, there's maybe been a little bit of selling, but not that much. And so I think that the market has underpinnings of some good support here. What's interesting is the move that we had in April, May, basically lasted about from that kind of congestive high was actually 3 months to almost the day from the previous major low. Well, January 1, or the first trading day of January, will be 3 months from October 1st low. So traders might want to watch that a little bit because that could be a little bit of a hiccup point. And then, of course, knowing that we're going into reports that are going to be very critical. Another thing that could have rallied us today, too, was that the FSA numbers come out on Monday, and there's a lot of anticipation that those numbers are going down.
Okay. So advice to producers, as so many folks have locked their corn in their bins, at these levels, should they start firing up the trucks to get it moved to town, or do you wait a little bit into January and see if that high holds around a little while?
I think what I would do is I would take advantage of this move, especially as we go towards the end of the year and the early part of January, the first few days of January. Yes, corn should try to buy acres, and we do expect that to occur. But the bottom line with new crop Dees corn, the 450 area, I think is a target. We got over 433 today. 450, 454 is an objective. There is a little spike high in that chart from there on the daily continuation. So in other words, when this year's December went off the board today on Friday, the next year's Dees will come on that on Monday. And of course, there's a little spread difference between 397 and that 433. So it leaves a gap. But the bottom line is the market's going to try to buy acres. And then we also are looking at less acres in Argentina on corn. Argentina's producer, you know, the government's trying to get them to plant corn, but there's a 20% tax on it with 40% inflation rate. And you've got high cattle prices down there as well. All of a sudden, land going back into pasture seems more worthy than maybe the high input costs into corn that isn't real profitable. So acres are going down. The USDA lowered Argentina by 1 million metric tons, but and they left Brazil the same. But I think as a producer, I would take advantage of this, because I think as we go through the winter, we may not be in this nice continual up mode. And then as you break in April, May, because if we have good weather like the Farmer's Almanac is predicting, I think prices will be going down into May and possibly into the early part of June. You'll get a chance to buy some calls back against the sales you've made.
Okay. Well, now let's jump down into soybeans. Good week again this week in the soybean market. Does that strength look like it's going to continue?
Well, I tell you, the bean market's real interesting. It's got a lot of traders perplexed. They don't understand why in the world it's here, and they're amazed it keeps holding. But I think that, one, we still have a good demand market. We've got China, you know, they've been the biggest player in the soybean market. And until China sees, we roll the year over and they see that the South American crop, the Brazilian crop, is going to be as big, or they feel comfortable with it, I think China is going to stay with us. Now, there's a trade delegation of Chinese crushers coming on Monday to the Chicago Board of Trade, and it's thought that they will ink a deal or sign a trade agreement with U.S. exporters. The trade remembers the last time this occurred back in September, back in Milwaukee, and it was for a 4.3 million metric ton agreement of soybeans, and 3 days later they announced a sale of 2.3 million metric tons. So traders are going to be thinking of that, and knowing that we've had, other than this past week, we were at 800 and some thousand metric tons. The previous 3 weeks, we were over 1 million metric tons, or at least at 1 million. And so traders are going to be pretty optimistic going into that, didn't want to be short. They're looking ahead at this. The other thing is that we have to keep in mind, the dollar's been moving higher, but I believe that China, first off, our export sales are not far from 90% of what the USDA has estimated for the whole year, and we're just barely into the second quarter. I think China's front-end loaded with their bean sales, and of course they've been taking them about as fast as they could, but still I think they're front-end loaded, and the reason being that they're front-end loaded was they wanted protection just in case, you know, not only a late planted spring, but if El Nino brings too much rain at harvest time, or they just ended up turning dry after the turn of the year, they wanted protection versus what happened a year ago.
Right.
I think they've been playing a dollar scenario. I think China knew, as well as, you know, I've been bullish the dollar for a year, that I think they were expecting a rise in the dollar, and they knew that with the dollar going higher, Brazilian beans are priced in dollars too, and so is Argentina. They might as well buy them today. They're just going to get more expensive tomorrow. They've loaded their boat, and when they finally realize that, hey, we can get them out of Brazil, and that'll be going into their harvest time, all of a sudden they'll cancel sales here. That'll drive the price even lower, and then they'll switch over to Brazil.
All right, so make some sales while we've got the price here.
I think so.
Now let's jump down and look at this livestock market. A bit of a down week in the cattle market. Fat cattle down $2.70. Is demand changing in this market?
Well, I think we've got, you know, it seems like we have moved some product this week. Movement was a little better on some of the hard down days in the product. But the bottom line is we are putting so much weight on these animals. They're weighing 1,650. I've even heard of some 1,700s. I've even heard of some at the packer breaking the chains on the, you know, as they're hanging. They're just big carcasses. But the bottom line is that I think we've been backing up a little bit of the product because of, you know, the high price. Also, I think the crude breaking like it has here has kind of given a feel of recession in other countries, and when in essence, I think maybe, yes, slowing in some countries, but also overproducing, and the U.S. has helped that out a little bit. I also think that the packer, as we turn the year over, because producers have made a lot of money on cattle as a cattle livestock producer, feeder, and I think he's elected to carry it. The market kind of caught him off guard, and we are in a very seasonal time when you do break. So I think the producer decided, okay, I've missed it. I'm not going to take less. They are very bullish yet. So they're carrying their cattle over into the new year with the thought they'll sell them after the turn of the year, put more weight on them. There was talk of 1,450-pound animals going back to the feedlots and being fed. Okay, I think that what happens is we're going to see our tonnage so huge, and I think packers are going to, with this break in the market, are starting to come back closer. They're getting some of their money back. They're still losing money. And I think after the turn of the year, it would not surprise me if packers all of a sudden turn on the cattle feeder and say, sorry, but we're docking severely for this. And when they get themselves into the black, they don't turn around and go back into the red very quickly.
You bet. And now that leads us right into the feeder cattle market. With just a little bit of time left, we had a question from one of our viewers on Twitter. Reed in Cloutier is asking, is this week, with its several limit down days, the beginning stages of the feeder cattle market tanking?
I think it is. And the reason being that I think this is that, you know, the demand is still good for feeders, but there's a bunch of them being sold between now and the end of the year. And granted, livestock feeders that feed them out fat are buying them because they're trying to get a tax deduction. And then after the turn of the year, they're into a whole new year. But the bottom line is that these feeder cattle, there's a lot of cow-calves out on wheat pastures. It's the first year we've had wheat pastures in some time. Other pastures are looking good too, so they're out on pastures. And on top of it, my understanding is that even some demand for cows started to back off today. I think that we've had cattle on feed basically at almost 100% for the past 3 months. When we get into next spring, we're going to have a lot of cattle around. I think the market's going down.
All right. Well, Sue Martin, thanks so much for being with us this week.
Thank you.
We'll discuss the lean hogs and finish our discussion on the feeder cattle market in our Market Plus segment online. And that's where we will continue our discussion. You can also find audio podcasts and streaming video of our program, as well as our new web-only feature, Video of the Week. Catch all the highlights and check out the links to our social media channels on our website as you stay connected with us, all exclusively at that Market to Market website. And be sure to join us next week when we'll see how crops grown in the Midwest are making a difference in the lives of people a continent away. Until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.